Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, June 26, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro events are the ECB front-running the Fed risk dollar strength, a strong two-year Treasury note auction, and improving corporate profits. So in terms of market implications, dovish comments by ECB Governing Council member Ali Rand reminded investors today that incremental delays by the Fed in easing policy risks trending dollar strength, as peer central banks are likely to continue cutting ahead of them. Trending dollar strength is typically bearish for global liquidity, and declining global liquidity is typically bearish for asset markets. Yesterday's strong two-year Treasury note auction was supportive of our Jay wants a soft landing theme. Rising Treasury supply is only bearish for asset markets if investor demand is not rising alongside it. FedEx results are supportive of our view that the corporate profit cycle upturn persists. Leading indicators point to continued strength over short to medium term time horizon. Transitioning to our 42 Macro dashboard here, as always, we'll wrap up with the question from our community. This one reads, it's about global liquidity. It says, hi, Skipper. Really appreciate the guidance through these challenging times. Thank you. Clarifying question, though. You agree with the Wow's view on liquidity and that there is a massive surge on the way, but then you say you disagree that it is likely materialized or something to that effect. So let me clarify that, because that is not completely accurate. The research that we published recently, the conclusion of the research was we did a big deep dive empirical study on what leads the liquidity cycle globally, studying hundreds of factors, hundreds of economic and market variables on a statistical basis to identify, which factor or a handful of factors best explain the liquidity cycle, the upturns and downturns in the liquidity cycle on a multi-year time horizon. And we arrived at the same conclusion that our friend Rob Paul arrived at with respect to his everything code analysis, in that lagged government debt growth is the best, creates the best, statistical fit for the global liquidity cycle itself. And so when you sort of run that analysis, if you look at the growth rate of global debt lagged by 3.5 years, which was the best, which is the best time interval for the lag in terms of producing the best fit. When you lag that by 3.5 years, you see that over the course of the next, call it year or so, there's a pretty sharp acceleration in global debt growth on a looking back 3.5 years, which is obviously with respect to COVID and historically speaking, so what that's effectively forecasting is a pretty sharp acceleration in global liquidity over the medium term. Now, what we said, and in addition to publishing that research, we said if you look at the sort of near term, coincident to kind of short to medium term time drivers, leading indicators of global liquidity, those are not aligned in a way that would suggest we're about to have this sharp acceleration in liquidity. So on the market side of things, you have the US dollar, currency volatility, real and nominal interest rates globally, and global bond market volatility. Currency vol and the US dollar are definitely moving in a direction that is not supportive of a continued uptrend in global liquidity. The interest rates and bond market volatility are, however, so that's kind of, they're offsetting each other. On the economic side of things, in terms of what leads liquidity on a coincident, or what is either coincident with the fluctuations in liquidity or leads it on a short to medium term time horizon, 3 to 6 months. The things on the economic side are global real GDP growth, global corporate profit growth, global unemployment, and global inflation. And with respect to global GDP growth, that's slowing. So that's a coincident negative factor for global liquidity. If you look at corporate profit growth, that's been stagnant, so hasn't really sent much signal in recent quarters. If you look at global unemployment, that's rising, and historically it's been a bearish factor for global liquidity on a coincident basis. And then lastly, if you look at global inflation, that's been slowing, so that's a positive factor, but it's still actually quite elevated. So we need to see a jump condition lower in inflation to see a jump condition higher in liquidity. So when you kind of do the kind of I don't want to say it's a rudimentary analysis, because obviously deep dive statistical study that allowed us to arrive at the conclusion that lagged global debt growth is the best fit for liquidity cycle on a multi-year time horizon. And the conclusion of that is that there's based on the trailing time series and global debt growth, you should be expecting, it's reasonable to expect a pretty sharp acceleration in liquidity over the next year or so. However, when you actually perform Bayesian inference, which is the difference between, blowing yourself up and actually making money in financial markets, is that Bayesian inference component. We layer on Bayesian inference, the drivers of liquidity on a coincident to medium-term time horizon, those are not aligned in a way that suggests we're about to experience a significant acceleration in the growth of global liquidity. So some significant changes have to happen in order for that to happen. So you need to see a jump condition lower in the dollar, jump condition lower in global inflation, global growth needs to stop slowing, global unemployment needs to stop rising, or some combination of all those things needs to occur in order for you to get a significant acceleration in global liquidity. So that was the conclusion that we arrived at in our recent research. Getting back to the question here, the question reads, I'm confused. Do you believe Rao is right on his call that BTC is about to enter the parabolic phase driven by liquidity, or do you have a different view? I would say we have a different view. And so, we are as structurally bullish on Bitcoin and risk assets as anyone. We've been consistently saying for about a year now that, the Fed's decision, or not about a year, so since going back to November of last year, when we got the Fed pivot alongside the Treasury pivot, we've been consistently saying that the Fed is, following a fourth turning style playbook in that they are kowtowing to fiscal dominance and they are allowing a structurally higher nominal GDP environment to persist, more likely to support the aggressive growth of the fiscal expansion that we've seen in recent years. And as a function of that, you have to be structurally bullish on risk assets, structurally bearish on defensive assets, certainly on an overweight, underweight basis. But I would suggest you might be able to be absolutely bearish on defensive assets from this starting price, but that's neither here nor there. So we agree that there is a long-term structural bull market in risk assets that investors would be remiss to not take advantage of in their portfolios. However, where Raul and I may disagree, I'm not sure, I'm not too familiar with his current market views, but where we may disagree is in the path that we take to achieve those structural bull markets. If you think about this from the perspective of managing risk, if you think about the structural forces that are supporting a long-term view, bullish bias in Bitcoin and stocks, et cetera, that's a 45-degree angle from today's point to the future price higher on a time function basis. However, there are cyclical cycles that you need to risk manage along the way, even though the trend on a multi-year time horizon is over the long term. And so where we differentiate ourselves from Rao and other competitors in terms of what we do, and I wouldn't even say Rao's a competitor, he's more of a friend. I've learned from him, he's learned from me over the years. But where we differentiate ourselves here at 42 Macro from other firms that purport to do what we do is that we are hyper focused on getting those fluctuations right. We understand that there's a structural bull market in Bitcoin. However, if the market regime changes because of a variety of factors, perhaps it's liquidity, perhaps it's sharp and disappointing and unexpected slowdown in growth, perhaps it's a sharp and unexpected acceleration in inflation, or some combination of all those things. If asset markets go into a risk-off market regime, Bitcoin could lose 20 to 40 to 50% of its value in a matter of months, like 2 to 3 months. And this has happened so many times in the past that I think you would be very remiss as an investor to be max long an asset heading into a risk-off market regime where, and particularly an asset that has such a high beta as Bitcoin is. And so this is why investors, thousands of investors around the world, are partnered with us, because we help them get those fluctuations right using our market regime nowcasting process, which is powered by our proprietary volatility adjusted momentum signal, which explains 98% of the returns in Bitcoin and about 80% of the returns in the S&P 500. So if you want to get 80% of the stock market right and almost 100% of Bitcoin right, you should be using our volatility adjusted momentum signal and the output of that signal, which is again our market regime nowcasting process, to stay on the right side of market risk. If, however, you prefer, kind of fanciful stories about where liquidity is going to be a year or two from now, that's fine. We're not disagreeing with that. What we are just saying is that you could lose 30 to 40 to 50% of your money, if not more, if we go into a risk-off market regime between now and that ending point. And so if you care about the path that asset markets are taking, then 42 Macro is for you. If you care about the destination, you are subjecting yourself to a significant amount of left tail risk in your portfolio. And either you may, if you're a buy side investor, you might not survive that. And if you're a retail investor, your wife might divorce you. So just be aware of that, or your husband might divorce you if you're the primary primary person managing the assets if you're a female. So next, who cares about that? We'll wrap it up there. This was a little long today, but it's a topic that I'm passionate about. Risk management, keeping our clients on the right side of market risk, helping them minimize downside capture in bear markets and maximize upside capture in bull markets with the exact same process, by the way. It's a quantitative process. That's something that we're obviously extremely passionate about. Gets me out of bed every morning and makes me very excited to communicate with our subscribers. So we'll wrap it up there. Darius Dale presenting our Macro Minute for Wednesday, June 26, 2024. Everyone have a wonderful day out there. Best of luck, and we'll catch you back here tomorrow. Cheers.